So you want to build wealth in Canada, huh? A lot of people believe you need some secret Wall Street knowledge or a massive inheritance to get ahead, but honestly, that's just not true. The biggest difference between those who build significant wealth and those who don't often comes down to one simple thing: using the right tools. And in Canada, the government literally gives you these incredible tools to grow your money completely tax-free or tax-deferred. It's like they're handing you a cheat code, but so many people just don't use it, or worse, they use it incorrectly and end up paying penalties. Think about it like this. You could invest your money the hard way, paying taxes on every single dollar you make, watching a big chunk of your profits get siphoned off by the CRA every single year, or you could use the accounts we're going to talk about today and keep all or at least most of that money for yourself. It's a no-brainer. We're talking about the TFSA, the RRSP and the RESP. It's not about timing the market or picking the next 10 bag of stock. It's about playing the long game smartly. So if you're ready to stop leaving free money on the table and start making your money work for you in the most efficient way possible, then you need to stick around. I'm going to go through everything step by step. No complicated jargon, just straight up actionable advice. And by the end of this video, you'll have a roadmap to unlocking Canada's best kept investment secrets. So get your notepad ready and let's get into it. TFSA is less of a savings account and more of a tax-free investment account. It's a special designation the government gives you, allowing you to invest your money and never ever pay a single cent of tax on. Every year, the government sets a contribution limit. For 2024, the TFSA contribution limit is $7,000. That means in 2024, you can put up to $7,000 into your TFSA. But the magic is that this contribution room is cumulative. If you've been eligible since 2009 when it started and have never contributed, you could have over $95,000 of contribution room available right now. Now, here's where people mess up, and you need to pay close attention to this. The biggest mistake is over-contributing. If you put in more money than your available contribution room allows, the CRA will hit you with a penalty of 1% per month on the excess amount. This can eat away at your returns very quickly, so it is absolutely crucial to track your contribution room. You can find this information on your CRA My Account online. Don't just guess or assume. Always check your official limit before you make a contribution to avoid any nasty surprises down the road. Another thing to remember is that a TFSA is not a day trading account. While you can buy and sell stocks, the CRA has been known to crack down on people who use their TFSA for active business trading. If they determine you're running a business within your TFSA, they can tax your gains as business income, defeating the whole purpose. Stick to buying and holding quality investments for the long term, and you'll unlock the true superpower of the TFSA. Next up, we have the OG of Canadian retirement accounts, the Registered Retirement Savings Plan, or the RRSP. TFSA is tax-free on the way out. The RRSP is all about getting a tax break now. The core concept is simple. Any money you contribute to your RRSP can be deducted from your taxable income for that year. This means you pay less tax today, which is a pretty sweet deal, especially if you're in a high tax bracket. Let's break that down with an example. Say you earn $80,000 a year and you contribute $10,000 to your RRSP. For tax purposes, it's like you only earn $70,000 that year. Depending on your provincial tax rate, that $10,000 contribution could easily get you a tax refund of $3,000 to $4,000. That's instant, guaranteed money back in your pocket from the government, which you can then turn around and invest. If you eventually start withdrawing the money in retirement, every dollar you take out is treated as income and is fully taxed at your marginal rate at that time. The whole strategy behind the RRSP is to contribute when you're in a high-income, high-tax bracket phase of your life and withdraw when you're in a low-income, low-tax bracket phase. Contribution limit for an RRSP is different from a TFSA. It's based on your income. Specifically, it's 18% of your previous year's earned income, up to a maximum annual limit set by the government. Just like the TFSA, any unused contribution room carries forward indefinitely. So it's important to check your Notice of Assessment or your CRA My Account to see exactly how much room you have. Don't just guess, because overcontributions here also come with a 1% per month penalty, and nobody wants to be giving the CRA extra money for no reason. But the RRSP has a few other cool tricks up its sleeve. There are two major programs that let you borrow from your RRSP tax-free for specific purposes. Cost of post-secondary education is just going up and up, and the RESP is the single best way to save for it. Why? Because the government literally gives you free money just for using it. I'm not kidding, it's one of the best deals going in personal finance, and it's designed specifically to help families save for their children's future education. Here's the magic ingredient. It's called the Canada Education Savings Grant, or the CESG. It's literally free money you're leaving on the table if you don't take advantage of it. Similar to the other registered accounts, all the money inside the RESP, your contributions, the government grants and the investment growth, compounds completely tax-free. No taxes on dividends, no taxes on interest, no capital gains tax. The money just gets to grow and grow unhindered for years. The lifetime contribution limit for an RESP is $50,000 per child. You can open an RESP as soon as your child is born and has a social insurance number, and the sooner you start, the more time you have for that compounding to work its magic alongside those government grants. First, you can keep the plan open for up to 36 years in case they change their mind. If those aren't options, you can withdraw your original contributions tax-free. The government grants have to be returned, but the investment growth can be transferred to your RSP if you have room, or withdrawn as cash. And there you have it. The use these accounts isn't just a nice to have, it's absolutely essential for building long-term wealth in this country. It's the difference between letting your money grow on its own terms and giving a huge slice of your hard-earned profits to the taxman every single year. Don't be the person who looks back in 20 or 30 years and wishes they had started sooner or used these accounts properly. The key takeaway is this: start and make it a habit. The power of compounding is on your side, but it needs time to higher income earner. Maximizing your RRSP to get that tax deduction becomes much more attractive. It's not about getting rich quick, it's about building sustainable wealth. Thank you so much for watching all the way to the end. I really appreciate you spending your time here. If you got any value out of this video at all, it would be a massive help if you could just gently tap that like button for the YouTube algorithm, and make sure you subscribe for more content just like this. Let me know down in the comments which account you're focusing on right now. Thanks again for watching.